Good afternoon and welcome to this month's Employee Benefits Compliance webinar. As we get started today, you will see two polling questions pop up on your screen. We know it was a tough renewal season for many employers, and we are curious about your thoughts now that you've had a chance to reflect on your renewal experience and outcomes. So please take a moment and provide your responses as we get started. And do note there are two polling questions. You may need to scroll down to see both of those questions. So as you are providing your responses, I would again like to welcome you to today's webinar. I am Jenny Bedeau with Assurex Global, and today the Loomlight team will be discussing a very timely topic, employer ACA reporting. And we would like to extend a special thank you to your local benefits advisors and consultants who are partners of Assurex Global for making this webinar series possible. And we do welcome your questions during the presentation. Please submit those questions using the Q&A function at the bottom of your screen. We will address as many as time allows, but note we do expect a lot of questions today, so if we aren't able to get to your question, please do reach out to that benefits broker who invited you here today for further assistance. If you are just joining us, you will see a couple of polling questions up on your screen. Please do take a moment and provide your responses. And we do record our sessions, so if you are looking for a link to the recording after the presentation, you can reach out to that benefits advisor for that link. They will also have a link to the presentation slides, but I will drop a link to those slides in our chat section here in just a couple of minutes as well. I am going to keep the poll open for just a few more minutes, or excuse me, a few more moments here so we can capture as many responses as possible. Your responses do help inform our monthly market check surveys, and they provide us with valuable benchmarking insights. And we also want to make sure that you are aware we just published our 2025 year in review and 2026 market outlook that has a lot of timely insight. So please do reach out to your benefits advisor if you'd like to learn more about that. All right. I will close out this poll and share the responses out with everyone here. Give me just a moment. It looks like many of you were surprised at that rate increase. We know from last month's poll that over half of you received rate increases at 7% or above. So probably that's why many of you were surprised at that. And we're seeing many of you kind of across the board as far as what you are looking at doing next as you kind of reevaluate or think about your next steps. So thank you again for providing your responses to that polling. But for now, we will move ahead and get into today's content. So joining us today from the Loomlight team, we have David Flotten and Dan Brady, senior consultants. Team, I will turn it over to you. Please take it away.
Thank you, Jenny. So welcome, everybody. Yep, it is that time of year we have to do our ACA reporting. So, it's a tough topic to do in an hour and do it any sort of justice. So we kind of have to pick and choose what we're going to talk about and what areas we're going to cover. So inevitably, we're not going to probably be able to hit on everything you would like to hear about or answer all of your questions, but we're going to do our best. So we're going to start by just a quick level set as to who has to do the reporting, what forms do you use, what are the due dates, electronic filing. We'll try and move through that as quickly as we can so that we can then move on and talk about the real stuff that people usually have a lot of questions about, which is coding. How do I fill out the 1095s in this particular situation? So we'll try and get to those as quickly as we can. We are going to focus on the 1095Cs, which is the reporting that applicable large employers have to do. We'll talk a little bit in the intro about who has to do 1095Bs, as in boy, but we're not going to go into detail as to how to fill those forms out. It just doesn't apply to as many people. Okay. All right. So I will get started here with logistics, who has to file, when, where, etc. Okay. So one thing that often we talk about ACA reporting as this one monolithic thing. And what a lot of people don't realize is there's actually two different reporting obligations. So that means there's two different groups of employers who are potentially subject to reporting. The first group is those who are applicable large employers. That is, they average 50 or more full-time equivalents in the preceding calendar year. So whether you're an ALE for 2025 is based on your average FTE count in 2024, and you're filing in 2026. So that's one group. Are you an applicable large employer? Again, if you need help, for most people, it's obvious. They're either well above or well below the 50 FTs. If you're in that squishy gray zone, talk to your brokers. They have tools that can help you do the math and figure out which side of the line you fall on. There's then a whole separate group of employers who also have to report, which is any employer with a self-funded or a level, which would include a level-funded group health plan. So both of these employer types of employers are subject to reporting requirements. And we get every year, we get, well, I'm under 50, so I don't have to report. Yeah, but you have a level funded plan, so yes, you do. Or I'm over 50, but I understand my insurance company is doing the reporting on my fully insured plan. That's true, but they're not doing the reporting you have to do as an ALE. So you, as any given employer, you might fall in one bucket, both buckets, or neither bucket. Okay. If you fall in either bucket, though, you have to report. And just for sake of completeness, we talk sometimes about the tax code sections where the reporting comes from. That's what the 6055 and 6056 are. The 6055 is the part that says report coverage on a self-funded plan. So that's why that's over here. 6056 is the part that says ALEs report to all your full-time employees. Okay. Quick little tangent off, if you are a single corporation employer, right? You're one company, you may have a bunch of divisions, but you're one corporation, either you're an ALE or you're not, and either you have a self-funded plan or you're not. Of course, we also can have what we call control groups, where we have multiple corporations, very often with common ownership is what defines a control group. And the question comes up, who has to do the reporting there when you've got a control group that maybe you're sharing a benefit plan? Again, if you need help determining if you are a controlled group, talk to your broker. Let's assume for this purpose, you've determined you are a control group with 3, 4, 5 different corporations together. Okay. Now, the rule gets a little weird. To figure out if you are an ALE, everybody gets lumped together. So all employees of all the control group members, add them all up to figure out if you're over 50. Okay. But once you figure out that you're over 50, now everybody is their own ALE, and you now blow them back apart again when it comes to doing the reporting. So those 4 or 5 companies, they add all their employees together, but once they go to actually report, each company is going to do its own 1094C and its own 1095C for its own employees, including the tiny one over here with only 5 people in it. They are going to have to do it themselves. Okay. So even if you're a control group, even if you share a group health plan with multiple companies, each separate corporation, each separate EIN has to do its own reporting. So if we take our 2 criteria, are you an ALE? Do you have a self-funded plan? You can fall in one of 4 buckets, right? ALE fully insured, ALE self-funded, not an ALE fully insured, not an ALE self-funded. Which of those quadrants you fall into tells you which form you're going to use, and even more specifically, which parts of the form you're going to use. Okay. If you're an ALE, you're going to do a 1094C, whether you're fully insured or self-funded. Okay. All parts. From there, it depends on if you're fully insured or self-funded. If you're fully insured ALE, you're doing Form 1095C, but you're only completing parts 1 and 2. If you're an ALE and self-funded, you're also doing a 1095C, but you're doing parts 1, 2, and 3. If you're not an ALE, if you're self-funded, now you're going to do the B forms, not the C forms. So under 50 FTEs, self-funded, you're going to use Form 1094B and 1095B. And then if you're neither, you're not an ALE, you're fully insured, you don't have any reporting to do. And when I use the term self-funded, that would include partially self-funded. So you have stop-loss coverage backing you up. It doesn't, if you're self-funding any part of the health plan, that would include, for example, an HRA too, you're self-funded. Now, when we talk about preparing the forms, there's really two distinct things that are going on here. And this may seem obvious and uh, maybe even trivial, but we found that a lot of people are convoluting these two things and getting things wrong. Okay. So, first of all, if you have to prepare the forms, you prepare the forms and then they get filed with the IRS. So, that's the first thing you have to do filing. Okay. Starting last year, electronic filing is mandatory basically for everybody. They've lowered the threshold as to who has to do mandatory electronic filing so low that as a practical matter, paper filing is just not an option anymore. That also means that you're probably going to need to hire a vendor to do the reporting or to do the filing anyway on your behalf. And even large employers with dedicated IT departments don't usually file directly with the IRS. It's complicated. Most people are you're going to hire a vendor who at least is going to do the filing for you. And there's vendors with varying levels of services from, we'll pull together all the codes, we'll generate the files, we'll actually file it, down to vendors who say, you do all the coding, upload it to our website, and then we do the filing. So, a range of services and not surprisingly, a range of prices. Separate from that, then, is you have to distribute the forms. Once they're prepared, the forms have to get distributed to the participants or to the employees, depending on which form we're talking about. And you have three options. You can either do it by mail, which is what everybody did historically. You can do it electronically, but you do need participant consent to do that. Or the latest tool we can use, and is now available for all forms, it used to be limited to B forms, is a notice of availability. And what that does is it allows you to put up a public notice. It has to be on a public website, not your intranet, not a benefits portal, not an internal email. You can do that as well, but it by itself is not good enough. You have to put up a notice on a public website with an email address, a physical address, and a phone number that people can call if they want a copy of their 1095 Bs or Cs. And if you do that, then you don't have to actually mail them out. You can just keep them, probably in electronic format, until somebody contacts you and says, I want a copy, and then you have 30 days to give it to them. That is only on distribution. You still have to do the filing. So this is not I don't have to even prepare the form excuse, because you still have to prepare the form in order to do the filing. It's purely about distribution that you can post this notice. Okay. This is just some sample language for the notice if you want to look at it. Due dates, here's the due dates for 2026. First one is largely irrelevant. That's the paper filing deadline, but as we've said, basically nobody can do that anymore. So really we've got two deadlines. March 2nd is the deadline to provide copies made available, or to provide the copies of the forms to the individuals. That includes the date by which the notice has to be posted if you're going to go the notice route. And then March 31st is the deadline to actually file with the IRS. The second deadline, the March 31st deadline, you can extend by 30 days for free. You just have to submit a form on time. The first deadline, the distribution deadline, has already been extended, so there's no room to extend that any further. One question I do want to touch on, because we are seeing more and more employers with ICRAs. And so the question is, if I'm an ALE offering an ICRA, where do I fall? An ICRA is a self-funded health plan. Okay? It's paying for individual fully insured plans, but we're talking about the ICRA, and the ICRA is itself self-funded. So if you're an ALE with an ICRA, you're doing both types of reporting, which means you're doing 1095Cs and you're doing parts 1, 2, and 3. All right, Dan, you want to talk about affordability?
Yeah, let's do it. Um, yeah, so getting to know affordability, most of you are probably familiar with the ACA requirement to offer affordable coverage under Section 4980H in order to avoid that subsection B penalty. Before kind of diving into affordability determinations and safe harbors, one thing we did want to mention is In terms of offering affordable coverage, and that is that as a practical matter, affordability is really only an issue for employees who waive coverage. That subsection B I mentioned, the penalty will only apply to a full-time employee who waives employer-sponsored coverage and then subsequently enrolls in subsidized coverage through the exchange. So what that basically means is that if you offer unaffordable coverage and the employee voluntarily enrolls in your unaffordable coverage, they cannot trigger that subsection B penalty. Moving on to kind of what is affordable. Coverage is affordable if the required employee-only contribution does not exceed a set percentage of their household income. It's 9.02% in 2025, 9.96 in 2026. For employees, the coverage is affordable if it's the required employee contribution for the lowest cost minimum value plan for employee-only coverage is affordable. Because employers don't necessarily have all of the information necessary to determine an employee's household income, the IRS allows employers to determine affordability using one of three safe harbors. So long as the minimum value coverage is affordable under one of those three safe harbors, the employer will be in compliance for purposes of avoiding the penalty. Use of those safe harbors does not change an individual's possible eligibility for exchange subsidies, which is tied to household income. That being said, the employer will not be liable for penalties if they can show the coverage is affordable under a safe harbor. There are some kind of rare circumstances where technically coverage would be affordable for penalty purposes and employer purposes, but unaffordable um, for subsidy eligibility. The employer can apply any of the safe harbors for any reasonable category of employees, provided it does so uniformly and consistently for everyone in that category. Reasonable categories for this purpose are going to be your specified job categories, compensation, so hourly versus salary, geographic location, and other similar business criteria. The employer can use different affordability safe harbors for each year. You're not locked into one safe harbor year after year. One caveat is that if you're using the W-2 safe harbor, then it has to be used for all 12 months. Um, and then lastly, the employer is not required to choose the safe harbor until the employer is preparing their reporting. I think this is kind of a common misconception that employers have to sort of declare a safe harbor at the start of the year. That's not the case. That being said, many employers do use a safe harbor to set their employer contribution amounts for the year. So in that sense, you would want to know it in advance. Just kind of focusing in on the three different safe harbors. First up is your federal poverty line safe harbor. Under the FPL, coverage offered to an employee is affordable if the cost of self-only coverage does not exceed that set percentage I talked about. For 2025, 9.02%. Um, the 2025 calendar year plan coverage would be affordable under the FPL safe harbor if it was less than $113 a month. That amount is a little bit higher for non-calendar year plans. Some of the benefits of the FPL is that it's usually the best to start with because it's simple and sort of guarantees affordability for all employees by setting that employee contribution amount below the threshold. The downside for employers really is that it generally comes with the largest employer contribution. The rate of pay safe harbor. So for hourly employees, the employee monthly contribution for single coverage is affordable if it does not exceed that 9.02% of the employee's hourly rate multiplied by a set 130 hours. That calculation uses the employee's rate of pay on the first day of the coverage period, unless their rate of pay is reduced, in which case you have to use that lower amount. Um, the interesting thing about this safe harbor is that 130 hours is used regardless of whether the employee actually works 130 hours during a calendar month. For non-hourly employees, the employee's monthly salary as of the first day of coverage period is used instead of the 130. multiplied by the hourly rate of pay. So, one other special thing about this is that if the monthly salary is reduced, including due to a reduction of hours, then that safe harbor is not available. Some of the benefits of rate of pay is that a nice thing is the affordability can be determined in advance, prospectively as a matter of plan design. Because it uses that assumed 130 hours worked and isn't impacted by leave of absences or reduction in hours. It protects the employer when the employee's hours may be less than full time, but the employer still has to provide coverage, for example, during a stability period. The negative things about the rate of pay is that you typically can't use it for tipped employees or employees that are compensated solely based on commissions. Then it would not be available. And then lastly, the W-2. Under this safe harbor, the employee's annual contribution for single coverage is affordable if it does not exceed that 9.02% of the employee's W-2 Box 1 wages. Um, what separates this safe harbor is that it's determined at the end of the year. Box 1 is used to report wages, bonuses, tips, salary, other compensation paid by the employer. However, it does not include non-taxable employee benefits such as those pre-tax contributions or 401k contributions. To use that method, the employee's required contribution has to remain a consistent amount or a consistent percentage of all of their W-2 wages during the year. This safe harbor is going to be most helpful for a workforce where the employer can accurately predict their W-2 wages, um, keeping in mind that pre-tax contributions aren't included. So you need to be sure, um, you need to have a pretty good understanding of what the end result W-2 wages are going to be. The downside is that unless the employer is very sure about that, they really cannot set the employee contribution at the start of the year and be sure it will be affordable by the end of the year when reporting is done. One question we get is how does the W-2 safe harbor work when the employee is eligible only a portion of the year? In that case, you're using a proportional calculation where their wages are multiplied by the number of calendar months coverage is offered over the number of calendar months of employment. So kind of jumping into 1095-C common scenarios. We just wanted to give you a quick kind of reference of the various line 14 and 16 codes that you're typically going to encounter when completing the 1095-C.
We should just emphasize these are the codes we use somewhere in this presentation. This is
Yep.
not all of them. There are
Yep.
way
Yep.
more than this.
Yep. And like I know been getting a lot of ICRA. There's special ICRA codes, that type of thing too.
Yeah.
Another kind of just a little bit of background information, just because we'll be talking about the measurement and look back methods quite a bit. Basically, the IRS gives employers two options to determine who is considered full time for ACA purposes. The first is the monthly measurement method. Um, as the name suggests, you're looking at their hours of service on a monthly basis. So employees that average 130 hours or more hours of service in a month are considered full time. For an employee with mostly regular full-time or part-time employees who aren't fluctuating, it will typically be a simpler and more flexible method. However, it is challenging if you have employees who are fluctuating around that 130 hour number. If the employee averages 130 hours a month, the employer won't know until the end of the month, and at that point, it's generally too late to make an offer of coverage. I think that's kind of a common misconception is that the monthly measurement method is not looking back at the previous month. It is based on that month. So if you have 130 in February, 130 hours in February, you need to offer them their full time in February. The other method is the look back measurement method. In this, if an employee averages 30 hours of service a week during a specified measurement period, then the employee is full time for the duration of the subsequent stability period of the same length, regardless of whether their hours fluctuate or employment status changes during the stability period. And I think we'll talk about some of these situations. But this method is generally better suited when the employer has employees who are fluctuating hours quite frequently. And then lastly, just classifying employees as full-time or part-time for reporting purposes in ACA is different than what an employer may designate as full-time or part-time. So it's just important to remember, for penalty purposes, these definitions are set in stone. Just a little bit 1095 framework here. Exactly what, so lines 14, 15, and 16 are really what we're focusing on the 1095C. Um, This section can be particularly challenging for employers in that it requires the employer or their vendors to develop systems and processes that have to track employees' information on a month-by-month basis. So I think that's kind of where you see a lot of issues. Line 14 was coverage offered. So this is indicating the type of offer made to the employee. It does not signify whether the employee actually enrolled and elected the coverage. There must be a code for each of the 12 months, regardless of whether the individual was employed for all 12 months or offered coverage. Most employers are using only two codes here, 1H for the months that coverage was not offered, and then another letter depending on the type of coverage. Um, as I mentioned, this offer code does not vary based on whether the employee or spouse or dependents actually enrolled in the coverage or what tier of coverage the employee enrolled in. It's based on the offer. One thing to point out for line 14 is that an offer of coverage is valid for the month only if coverage was available every day during the month. So a month that an employee was eligible for only, a couple days or a couple weeks is typically coded as 1H, indicating no offer was made. Line 15, this is basically how much coverage costs. It reflects the amount the employee must contribute to enroll in single minimum value coverage, the lowest cost option. It does not reflect the actual coverage they enrolled in if multiple options are available. If the contribution varies by employee, like it's age banded or something like that, the employer has to calculate that amount separately for each employee when they're doing their reporting. Um, if an employer offered minimum value coverage to the employee and the employer is using a qualifying offer method, which we'll talk about later, they can leave line 15 and 16 blank. And then lastly, line 16, this is a very important section of the 1095C. This is where kind of what the IRS looks at in terms of, making sure that if the employee was full-time, what coverage was offered. Um, Really, here the employer is indicating why coverage was either offered or it was not. If the employee elected coverage for the month, the employer is using code 2C that they enrolled in coverage, even if other codes may apply. Um, if they were not offered coverage, typically it's 2A. They were not employed, or 2B, part-time, 2D, limited non-assessment periods, which we'll talk about. There is no specific code to indicate a waiver. I talked about the importance of and significance of waiving coverage, but if the employee was offered coverage and waived, then you're typically entering the applicable affordability safe harbor, 2F, 2G, or 2H, or you're leaving it blank if nothing applies. 16 is one of those sections where we see reporting errors that trigger penalties. For example, if the employer indicates 1H, no offer of coverage on line 14, without providing a 2 code, it's suggesting that a full-time employee was not offered coverage for the month, and you're not indicating why. If the employer indicates that coverage was offered for the month, for example, 1E, without providing the 2 code on line 16, it suggests that an offer of coverage was waived and was unaffordable. So that's where those safe harbors come into play. So kind of getting into some specific scenarios here. Starting out with the easiest one, probably. Here we have an ongoing full-time employee who is offered minimum value coverage and enrolled in fully insured coverage for the year. Reporting is pretty straightforward. 1E indicating that minimum value coverage was offered. Line 15 has your cost of coverage. And then line 16 to C is indicating that they enrolled in the coverage. If they waived coverage, the employer is still using 1E to indicate that an offer of coverage was made. 15, line 15 still includes the same cost of coverage. And then the difference here is line 16. We're using code 2F with the assumption that the employer used the W-2 safe harbor to determine that the coverage was affordable. So here we're focusing kind of on code 1A and qualifying offers of coverage. If the employer offers minimum value coverage to full-time employees, spouses, and children that meets the FPL safe harbor, it is considered a qualifying offer. If 1A is used, I mentioned this, if 1A is used on line 14, then you can leave line 15 and 16 blank. Um, this is because, as a matter of definition, the fact that you're indicating a qualifying offer was made essentially clarifies that the coverage offered was affordable. A question we get a lot is what is the difference between code 1A and 1E, since they both indicate an offer of minimum value coverage. And the difference is really based solely on whether the contribution meets the FPL safe harbor. It can be easier to think of it as that code 1A is the same thing as code 1E plus an offer that meets FPL. Instead of using 1A, you could use 1E, enter the contribution amount on line 15, and then enter code 2G on line 16. So that would basically provide the exact same information. So using 1A is really just a way to simplify the reporting. Moving on to some new hire examples. So there are a few things that are kind of going to impact how reporting is handled for new hires, and that's going to be, as David talked about, whether the plan is fully insured or self-insured, whether the employee was hired on as full-time or part-time, whether the ALE is using that monthly or look-back measurement method that I talked about, and then subsequently whether the employee is considered variable hour, or maybe if they fit into a seasonal employee exception. For this example, the facts are that the employee was hired as full-time mid-April, was subject to a waiting period, and then became eligible for coverage June 1. They were offered fully insured minimum value coverage that costs $150 a month, and the employee enrolled in that coverage. So here's kind of what the 1095C would look like. 1H. For the few first months there, indicating that no offer of coverage, and 2A, they were not an employee. Um, and then we move to 1H, no offer of coverage. 2D, that's that waiting period. Waiting period is one of the situations that is considered a limited non-assessment period. So we're coding that as 2D. And then finally, once the employees offered coverage, we're using 1E, minimum value offered to the employee, and at least MEC offered to spouses and dependents, and then 2C indicating that they enrolled in the coverage. Example two, so the facts here are that the ALE uses a look-back measurement method, and the employee was hired as a variable hour employee mid-July during the previous year. They were determined to be full-time following a 12-month initial measurement period and are eligible for coverage in September following a 1-month administrative period. They were offered self-insured minimum value coverage costing $75 a month, which we are assuming meets the qualifying offer method. Um, and the employee, in this case, the employee and spouse enrolled in coverage. So here we have 1H indicating that no offer of coverage was made, and then 2D, the limited non-assessment period. There are various situations that are considered, that fall within a limited non-assessment period, one of which is that initial measurement period under the look-back method. So we're indicating 2D there. And then because it's a qualifying offer, we're using 1A. and you can leave line 15 blank. You could also leave 16 blank as well, but for this example, we've included 2C that they enrolled. And then because this is a self-insured plan, we have to complete part 3, and that is where we are indicating um, where the employee and spouse were covered September through December. So similar facts with this one, except that there isn't a qualifying offer. The self-insured minimum value coverage costs $175 a month, and the employee and family declined coverage in this case. So again, 1H, 2D, limited non-assessment period. 1E, a minimum value was offered to the employee and MEC offered to spouse and dependents. And then here, we're 2F, they waived that coverage. We're indicating um, that we used the W-2 affordability safe harbor and that coverage was affordable. In this case, Part 3 is left blank because the employee and spouse did not enroll in the self-insured plan. Temporary employee example. So this is one that we see a lot of issues with. Facts here, employer hired a temporary employee for 6 months from March to August. The employee averaged 130 hours of service per month while employed. So as I talked about, they are considered full-time under the ACA, even if the employer does not classify temp employees as full-time under their own, general employment policies. The employer does not extend eligibility under their plan to temporary employees. And in this case, the employer uses the monthly measurement method. And that's important because under the monthly method, the seasonal employee exception is not available. That is only available under the look back method. So as you can see here, there are some gaps, and that is because the employer did not offer coverage from March to August. And because of that, if the employee enrolled in subsidized coverage through the exchange, they could trigger a penalty for those months that they were considered full-time and not offered coverage. So um, we have a lot of employers who have temporary employees. If you're using the look back and they don't qualify as seasonal, or if you're using the monthly method, you typically want to make sure you're offering them coverage like any other full-time employee, because that's essentially how they're treated for ACA purposes.
Here we go. This one's me. All right. So I think probably one of the things you can see is kind of a recurring theme here is coding gets difficult when things change. And nothing illustrates that better than when people start moving between full-time and part-time status. So we're going to do a few examples to kind of illustrate that. And what I'm going to do here is show you the way I think most people do this. And you can argue whether it's correct or not. The coding is correct. The question is what the employer doing correct? All right. So employer uses look back measurement method. Measurement period from November to October, admin period of November to December, stability period January to December. Employee averages 30 hours a week during the 11/1/23 to 10/31/24 measurement period, meaning they are full-time for all of 2025. They're offered coverage and they enroll themselves and their spouse as of 1/1/25, and the coverage they're offered satisfies the rate of pay safe harbor. Then the employee transfers to a part-time position on May 15th, 2025. Now, before we get to the reporting, the first question we have to ask is, what happens to that employee's coverage when they move into a part-time position? Okay. Do they get to keep it and just keep going? Or are they COBRA'd because they're no longer a full-time employee? And I think what most employers would do is to say, well, they're COBRA'd. They're not full-time anymore. Their schedule has changed. You can do that, but there's a catch, okay? So that's what this employer does. They COBRA them as of June 1st. The cost of single COBRA coverage is $625 a month, which does not satisfy the rate of pay safe harbor. And this employee says, I'm not paying that, and waives the COBRA. Again, this is legit. However, there's an important caveat. They may be part-time in your HRIS system. They may have a part-time work schedule. For ACA purposes, they are still full-time. That is the point of a stability period. Their full-time, part-time status for ACA purposes doesn't change just because their schedule changes. And so that's going to affect the way this coding works, okay? So a few things to point out. So the first 5 months of the year, just straightforward. We offered them coverage 1E, cost $125, they enrolled 2C. June 1st, we COBRA them due to a reduction in hours. So the first thing to notice here is there is this goofy rule that the IRS says if you offer COBRA to somebody due to a reduction in hours and they keep working for you, the line 14 code is supposed to change to reflect the people who were offered COBRA. So in this case, even though they offered coverage to the employee, spouse, and children at the beginning of the year, that's 1E, only the employee and spouse enrolled, so only in the employee and spouse are offered COBRA in June. That is 1D as in dog. Okay? This rule is only applicable to COBRA due to reduction in hours. COBRA due to termination of employment, totally different. Okay, so that's the first thing to notice here is the line 14 code actually changes to reflect who was offered COBRA. Second, the line 15 amount changes because the employee can no longer obtain coverage for single coverage for $125 a month. It's now going to cost them $625 a month if they want single COBRA coverage. So that line 15 amount now has to change. And now what can we do on line 16? Well, they're not enrolled anymore, so we can't use 2C. It's not affordable anymore, so we can't use 2H. And because of the look-back measurement rules, they are still full-time. You cannot put 2B in here because for ACA purposes, this employee is still a full-time employee because they are still in the same stability period. As a result, you get a bunch of blanks from June to December, and as we said earlier, that's what we're trying to avoid, but in this case, we can't avoid it. And so this employee is a penalty risk from the months of June to December if they go to the exchange and get a subsidy. If you want to eliminate that risk, you don't COBRA them. You say, look, you're still full-time as far as the ACA is concerned, therefore you remain eligible for coverage at least through the end of the stability period, and now nothing changes. Okay. So that's what most people want to do. If you want to, or rather, this is what's coded is what most people do. If you want to avoid that penalty risk of having blanks on line 16, what you need to do is not COBRA them. Now, there is another option, which is what we call the full-time to part-time exception, which you're allowed to use if these conditions are met. The employee has been offered coverage continuously since date of hire, not including the waiting period. They change from a full-time to a part-time position in terms of scheduling. Then in the 3 months following that change in schedule, they have less than 130 hours of service. So that's June, July, and August in this example. And if those two things are true, the employer is allowed to start using the monthly measurement for this employee starting in September of 2025. And then they can continue doing that through the end of this stability period and the next one if necessary. The effect of that is if they stick to their new part-time schedule, they will drop to ACA part-time status starting in that 4th month in September of 2025. So in this example, the employer takes advantage of that full-time to part-time exception and they don't COBRA them right away. They delay until September when they expect their status to change. And so now what happens is we get 1E through August, 125 through August, 2C through August. Then we COBRA them. Now this code switches to 1D in September. We have to now record the COBRA rate. But now in this case, we are allowed to use 2B because under the full-time to part-time exception, we can start measuring this employee monthly. And he is in fact working less than 130 hours a month. So we are allowed to put a 2B on line 16 in this situation. Okay. This is optional. You're not required to use it if you don't want to, but it's there if these conditions are met. What if you don't use look back? What if you use monthly? Well, that's kind of the same as the last example, except that you're always doing monthly. You're always measuring month by month. So under monthly measurement method, this person will drop to part-time as soon as their schedule changes. Okay. So we can start using 2B right away in June if we're using monthly measurement method. Now, in this case, monthly works to your advantage. It doesn't always. In a lot of cases, look back is your advantage. So don't take away from this that I should be using monthly. There's a lot of downsides to monthly. We can look at it going the other direction. What happens if somebody averaged less than 30 hours a week in the last measurement period, and then they get moved into a full-time position? Most employers in that situation will offer the employee coverage. So that's what this employer does. The employee enrolls themselves and their spouse in the coverage as of June 1st. And we're going to assume a fully insured plan for this purpose. So the question is, how do we code this? And the answer is we don't. There actually is no 1095C here. And why is that? Well, it's because of the look back measurement rule. Because they average less than 30 hours a week in the last measurement period, they are ACA part-time for all of 2025. It doesn't matter that they transferred to a full-time position in May. For ACA purposes, they were part-time all year. And if they were part-time all year, so there's no month they were fully insured, or I'm sorry, no month they were full-time, you don't issue a 1095C. This also is why we've assumed a fully insured plan, because they are also never enrolled in self-funded coverage. This would be different if the plan was self-funded. But for a fully insured plan in this scenario, even though the employee is offered coverage in May and then actually even enrolls, you still do not have to issue a 1095C because they aren't full-time. Now, by contrast, if you use the monthly measurement method, now you do have to issue a 1095 because this person is going to be ACA full-time starting in June. So now there are months where the person is full-time and we do have to do the 1095. Yeah. Leave of absence is another one which causes headaches. I tried to roll everything into one example here, so hopefully it doesn't get it too confusing. But we're going to have an FMLA leave, a non-FMLA leave, a COBRA situation kicking in here as well, and then coming back to work. Okay. So this employee begins unpaid FMLA leave starting March 9th. By the way, they enroll in single coverage back in January. They go on FMLA leave March 9th, exhaust their 12 weeks of FMLA leave on May 31st. They need an additional 4 months of leave, which is granted. Company policy allows the employees on non-FMLA leave to keep their coverage for 2 months, and at that point, they are COBRA'd. The employee in this scenario waives the COBRA coverage, it's too expensive, and then they return to work and coverage is reinstated at active employee rates as of October 1st. Note that this may be different under your policies. Your policies may say you're COBRA'd immediately at the end of FMLA leave. Your policies may not allow the employee to be reinstated right away when they return to work. So this is the coding for this particular employer's situation and their leave of absence policies. So if we look, January, February, before the leave starts, everything's the same as normal. Now, FMLA leave, of course, we have to maintain coverage as though they were still actively working. Well, for coding purposes, that means nothing changes. They still are 1E, it's still 125, and in this case, the employee maintained the coverage, so we keep the 2 Cs. We then move into non-FMLA starting in June, but again, company policy says they can keep the coverage for 2 months, and so again, nothing changes for June and July. But starting in August, we COBRA this person. So again, COBRA due to reduction in hours, the line 14 code changes. In this case, it changes to 1B because the only person we offered COBRA to was the employee themselves. Then we have the COBRA rate. Now, in this example, I've assumed monthly measurement method, which is why we're allowed to put 2B in August and September. Then the employee comes back and it switches back to 2C. But this 2B only works under the monthly measurement method. If they use the look back measurement method, everything is the same except I can't put 2B in August and September. Because of the stability period, they are still full-time even though they're out on non-FMLA leave. One other thing to note, there are special rules that address how you count FMLA leave next year. So this FMLA leave is taking place in a new measurement period that affects what happens in 2026. The rules say that FMLA leave, we basically have to credit them for hours of service that they, as though they were working during FMLA leave. But for the periods of non-FMLA leave, they get credited with 0 hours because they aren't working. Okay, for sake of time, I'm just going to throw up the termination of employment examples because these are all basically termination of employment is pretty much the same. The only difference being what happens in the month where the employee actually terminates. And health plans work one of two ways. Either the employee terminates and coverage runs to the end of the month. That's option one. Or coverage terminates and coverage ends immediately on the last day of employment. That's option two. The only thing that is different is that we can't claim 1E under option two because we did not offer coverage all for the entire month. It ended partway through the month. However, there is a special just because the IRS said so rule that says in this scenario where coverage ends mid-month due to termination of employment, you are allowed to put 2B in that month. It doesn't mean what it normally means. It's just specific to this scenario. But importantly, notice that in all the months after the termination, the coding is always 1H2A, even though this employee elects COBRA. They actually take it. It doesn't matter. When it's termination of employment, it always is coded 1H and 2A for every month after the termination date. All right, Dan, last section for you.
Yeah. One quick I saw there was a just to reiterate why does the monthly method not always work in the employer's favor? What can happen is let's say you have employees who typically work 120 hours a month and they're not offered coverage. Let's say an employee picks up some extra shifts that month and it bumps their hours of service over 130. Well, the employer is not going to know that or realize that until after the end of the month when they're calculating the hours of service. And at that point, it's already too late. If they didn't offer coverage for that month, they could be exposed to potential B penalties.
Or imagine you've got a variable hour employee who literally their hours fluctuate above and below 130 hours a month, each and every month. They
Mhm.
are constantly going back and forth, which is a nightmare to track, but it's also for the reason Dan just said, it's almost impossible for you to keep up with offering coverage in the correct months.
Yeah. And then also terminating coverage and you're basically going
Cobra,
back and forth monthly. It's
yeah,
almost impossible to get right.
yep.
Um, so to kind of dig into the 1094C, we just wanted to touch on kind of one section because this is arguably the most important part of the 1094, 1095 reporting. Um, this section, part three, is where the ALE indicates to the IRS whether the employer offered minimum essential coverage to at least 95% um, of their full-time employees and dependents as required under 4980H, the subsection A. In other words, it's basically the information that the IRS uses to determine whether the ALE is liable for penalties under subsection A. So checking the no box here exposes the ALE to those A penalties, even if one full-time employee obtains subsidized coverage on the exchange. And just a reminder of the significance of that, the A penalty is kind of the big penalty and is multiplied by the total number of full-time employees less the first 30. regardless of how many employees were actually offered coverage. So, and it only takes one employee to receive subsidized coverage. So, in 2026, for example, that A penalty, I believe, is around $3,300 a year. If you had an ALE with 100 full-time employees, less the first 30, you're looking at a potential penalty of 200,000. If you had 500 employees, that penalty can be upwards of $1.5 million. So very different from the subsection B penalty that's going to apply on a per employee basis. I think we have some examples, yeah, of that's essentially what this section should look like. You should be checking all the boxes. The only time you would not have all 12 months checked yes is if the employer didn't offer coverage to um, at least 95% of their employees in a given month. And I think one other issue that can happen is using a vendor. Sometimes it will auto default to no. So it's just another reason, you really want to make sure before finalizing the reporting that you're confirming that these sections are accurate. And yeah, here's some examples, kind of, if you see this, either one of these, that should be an immediate red flag that would need to be, you know, figured out before submitting.
And just if it's not obvious, what's going on here on the left-hand side, if you look down to October, November, and December, you'll see there's no checkbox. Those months are blank. The IRS reads a blank in this section as meaning no. So it's the equivalent as if you checked no in October, November, and December. And let me say just one other thing. I was talking with my colleague, our colleague Reagan, before we started, and we're trying to figure out, this is by far the most common mistake we see on reporting, is that this randomly weird no's show up, or all 12 months are marked no, or there's blanks. And so we were like, why don't people notice this? Especially after we're sitting here telling you this is the most important thing, pay attention. I think it's because in a lot of reporting software, you can flip through the employees and it will show you a completed 1095-C. It may not ever show you a completed 1094-C that looks like this. It may be on some other screen somewhere. It may be in a file that you have to go look at and interpret. I think that is often the problem, is it doesn't present it either automatically or in a nice, obvious way as to what it's actually filling, how it is filling out the form. So you kind of have to make a point, after you're done your reporting, after you've checked all the 1095s and everything looks good there, you have to stop and ask yourself, where is the 1094? How do I go review what the 1094 looks like and how it's answered this question? Now, you may need to ask your reporting vendor, where do I find that? But please make a point of doing that. If you get nothing else out of this today, review your 1094-C before you file it. We can fix this after the fact, but it's much better to get it right than have to explain to your boss, no, we really don't owe the IRS $2.5 million. I just forgot to check a box. You don't want to say that if you can avoid it. So please figure out how you check the 1094-Cs in your reporting software and make sure it's always saying yes. I think we got through an awful lot of questions. I know there's some out there still. So, if we didn't get to your question, please, submit it to your broker. They can get it to somebody who should be able to help you, whether it's us or somebody in their own internal compliance department. And then Jenny, I think you had just a quick wrap up here.
Yes, just a couple comments. Thank you, David. Thank you, Dan. You guys certainly are a wealth of knowledge. Certainly appreciate your expertise today. Thank you to our audience for tuning in. Again, I want to just remind you, we do record these webinars. So if you are looking for a link to the recording, you can get that from the benefits advisor who invited you here today. They should have that within the next day or so. And as David mentioned, if you do have further questions, those are the folks to reach out to. They will be able to assist you. And again, thank you to those benefits advisors and consultants consultants who are partners of Assurex Global for making today's webinar possible. That does conclude our webinar. Thank you again for joining us and have a wonderful rest of your day.